In this video, we're going to go into a bit more detail about using what we can't see as well as what we can. So at this time, the markets have slowed down considerably. We can see we're 70,000 contracts below the average for the time of day. We aren't long after the open, and we've tested the prior day's value low once, and now we're going down towards it again. We can see that the Dow is at its lows and the NASDAQ is going towards its highs. The NYSE TICK hasn't put in any major extremes, so we're definitely looking for a range trade. We can see the volume profile is D-shaped, and so we're looking at the extremes of that D shape as potential entry points. So in terms of trade location, we've built the profile a little. We can see the lower extreme lines up with yesterday's value low, so we have a good place to enter. Now in more normal market conditions, we might expect to see momentum come in on our side after our entry. The trouble is, when a market has slowed down to this extent, we rarely see that to the same extent. What we see is more of a lazy grind up to the opposite end of the range. So if you want to stick with the same market through the summertime and the wintertime periods, then you'll have to look for different things in the order flow, or in some cases for the lack of things. So we have a trade entry at 64.50. Really for no other reason than we saw over 600 contracts trade there, which isn't a great deal, but it's more than we saw at other levels on the way down. Now it goes past our entry point a couple of ticks to retest the value low, and then we start to move up. Now I got in a bit early here because I was afraid of not getting a fill any lower down. Now we don't see a lot of contracts trade after we enter. There's no huge imbalance in the strength meter. We don't see particularly that many more large trades on the buy side or the sell side on the reconstructed tape. The NASDAQ is supporting our trade, it's moving up towards the highs, but the Dow really isn't. The trade is balanced, but the trade location itself is still on our side. So unless we see size coming in against us and price then moving down, we'll stick with the trade, but obviously not let it run too far offside. Now, as we finally see some upside momentum come in, we can see the market's really still balanced. We don't have that kind of 1.5 to 2 times the buys to sells that we'd see in a good upside momentum move. The point of control is 21.65, which means that's where the most contracts traded so far today, and also where we are likely to trade more contracts each time we go through that price. The open price, a common reversal point, is at 21.65.75. So we have our first target just ahead of that price. Again, that is based purely on trade location and not order flow. Our final target at 66.50 is just basically the high of the range. So we're trying to get the market to go to the high of the range, the other extreme of the range, from the low of the range. And on a range-bound market, that's basically as good as it gets. As we get up to the top of the range, we get a fill. And as we start to move down, we can see that over 1,000 contracts trade into 21.66. So it appears at that point that the offers are absorbing buying, which would give us a signal to the short side. Now I tend not to reverse trades. I like to step back and have a think between trades myself. But this would have been a valid signal to trade right to the other side of the range, knowing that if you get a couple of ticks up through the price where those 1,000 contracts traded, then you're wrong about that trade. With these summertime ranges, you have a choice. You can stick with your own market knowing that it's going to behave very differently. So in my case, I trade the S&P 500 futures, and one summer I sat down with the S&P 500 futures and just basically figured out how to trade the summertime chop. Another way of approaching this is to go to a thinner market. So if you look right now at the 6E, at the NASDAQ futures, you'll find that they're trading right now the sort of liquidity and volatility that would normally be associated with the S&P 500 futures. So what you could do is you could stick with the same market and trade knowing you have a smaller range and less volatility, and you have to look for slightly different things. Or you could move to a market that would normally be a little bit too volatile for you, knowing that the conditions that that market's in the summertime are actually a lot more similar to the market you're usually trading. So right now, the NASDAQ, the 6E are trading a little bit more like the S&P 500 futures usually trades. Anyway, just some food for thought. So good luck with your trading over the summertime.